How do you take your money out without worrying about running out of money in retirement? If you're in or near retirement, one of the biggest questions you'll face isn't how to save for retirement, it's how to take money out of your retirement accounts and the smartest way possible. Because here's the truth. What you do with your money in retirement often matters even more than what you did to build it. So today, I want to walk you through the different retirement withdrawal strategies, the pros and the cons of each, and then we're going to share why I personally favor a strategy that lets you live off dividends and interest, or what your portfolio builds for you, with tax efficiency in mind. When I've met with clients over the years, one thing that I've found out is that there's basically 5 things that you need to make your retirement plan work. This is basically what everyone wants. They all want the most returns with the least amount of risk. They want their income without drawing down the principal, and then they want it tax efficiently. Sound about right? So by the end of this, you'll have a much clearer picture of how to take income in retirement without running out of money and without paying more taxes than you have to. All right, so let's talk about the big picture. What's the goal in retirement withdrawals? When most people think about retirement, they picture the freedom, travel, grandkids, hobbies, volunteering, whatever gives your life meaning. What my dad would always say is that the memories last longer than the money will. But to enjoy all that, you need reliable income, money coming in every month, whether the market's up or down. So our goal isn't just to withdraw money, it's to create a dependable, sustainable, and tax-efficient retirement paycheck. That paycheck could come from a few different places. Your Social Security benefits, pensions, if you're lucky enough to have one, distributions from retirement accounts, and ideally income from your investments, such as dividends and interest. The challenge? If you withdraw too much, too fast, you risk running out of money. Withdraw too little, and you might not fully enjoy your retirement. That's why you've saved all this money, right? So let's break down the different strategies that a lot of retirees can use and see which ones stand the test of time. Number 1, the 4% rule. And you might have heard this one already, and you might be bored of it, but the 4% rule is probably the most famous withdrawal strategy. It came from a study in the 1990s by a financial planner named Bill Bengen. What he's found is that if you withdraw 4% out of your portfolio in your first year of retirement and then increase that withdrawal by inflation each year, your money would have lasted at least 30 years, even through bad markets. So if you had $1 million portfolio, you'd withdraw $40,000 in year 1. Next year, you'd increase it by inflation, say $41,200, and so on. The good? It's simple. You know what to expect. The bad? Markets and inflation aren't static. Some years you might be forced to sell assets at a loss just to keep up your income. And with today's lower bond yields and potentially higher volatility, the 4% rule might not hold up as well as it once did. If you retired in a bad market, like 2008 or 2022, that sequence of returns risk could dramatically shorten how long your portfolio lasts. Number 2, the bucket strategy. So next we have what we call the bucket strategy, a more dynamic approach that divides your money into time horizons. You might have bucket 1, which is the cash and short-term bonds for the next 1 to 3 years of income. Bucket 2 would be intermediate term investments for the next 3 to 10 years. And then bucket 3 is growth investments, stocks or equity funds for income you won't need for 10 or more years. The idea is that during market downturns, you're only drawing income from your safe buckets, giving your growth bucket time to recover and grow. It helps to protect against selling at the wrong time and gives retirees peace of mind. The downside, it requires more active management and periodic balancing. And if inflation runs high for a while, your short-term buckets might run dry faster than expected. Number 3, dynamic withdrawal strategies. So another approach is dynamic withdrawals, sometimes called a guardrail strategy. Instead of taking a fixed percentage, your withdrawals adjust based on your portfolio, how your portfolio performs. In good years, you might take a little more, and in bad years, you tighten the belt. It's mathematically elegant and increases the odds your money lasts, but for many retirees, it's emotionally hard, Imagine taking a 10% pay cut one year just because the market dropped, even though your expenses didn't. So while dynamic withdrawals work on paper, they're not always practical for real people living real lives. Number 4, annuities. So I know annuities may not be the prettiest word, and a lot of people dislike them, and some people love them. And annuities are insurance products that can guarantee lifetime income. You hand over a chunk of money to an insurance company, and in return, they promise you to pay you a certain amount for your life, like your own pension. Annuities can provide that peace of mind because that paycheck keeps coming in day and day out, but they come with trade-offs. You lose liquidity and flexibility. The payouts can be lower than market-based returns, and depending on the type of annuity, fees can be high. For some retirees, especially those without pensions, an annuity can be a valuable piece of the puzzle, but it shouldn't be your only income source. Number 5, the dividend and interest income strategy. So let's talk about the approach I personally favor for many of my clients, living off dividends and interest. This strategy focuses on building a portfolio that generates consistent income through dividends, interest payments, and other distributions, rather than constantly selling investments. It's about making your money work for you so you can live off the income it produces, rather than depleting your principal. So let's look at how the dividend and interest strategy works. The core idea is, instead of drawing down your portfolio by selling shares, you structure your investments so that the income they generate from dividends, bond interest, and maybe even rental income covers your living expenses. So for example, if your retirement expenses are $80,000 per year and your Social Security covers only $40,000 of that, you only need $40,000 from your investments. If your portfolio gives you income of dividends and interest of 4%, you'd need roughly $1 million portfolio to generate that income without touching the principal. Now, of course, yields fluctuate, dividends can change, and you still need diversification. But if done right, this approach can create a powerful sense of stability. You wake up each month knowing your income is coming in, and you don't have to worry about selling during a downturn. It really helps out with the psychological part because it helps you be able to spend your money when you want to spend your money rather than worrying about what the market is doing every single day. 1, you're not selling in down markets. The biggest danger to most retirees is being forced to sell investments during a market downturn just to fund their lifestyle. If you're living off dividends and interest, that pressure is reduced. You're not relying on selling shares at the worst possible time. That's a major advantage, especially in volatile markets. And it's a really big advantage when it comes to the psychological part to investing. Because you get your income, you aren't always worried about what the market's doing because the income's still coming in. So that's where it could feel psychologically safer. There's a huge emotional difference between spending down your nest egg and living off of your income. Many retirees find it comforting to know the principal remains intact, even if it fluctuates in value. They feel better knowing they're not draining it each year. That confidence can help retirees stick with their plan during tough markets. And it can also be more tax efficient. Here's where things get really interesting. Not all income is taxed the same. Qualified dividends and long-term capital gains are taxed at 0 to 20% depending on your income. Now, most of it would be taxed between 0 to 15% because that's the biggest threshold, and interest from municipal bonds can be tax-free at the federal level. Withdrawals from Roth IRAs are tax-free altogether, even if it's income from the Roth IRA. And by strategically managing which accounts you draw from, taxable, tax-deferred, or Roth, you can significantly lower your lifetime tax bill. This is where a good retirement planner can save you tens or even hundreds of thousands of dollars over your lifetime. Then we also have the flexibility. If you need more income one year, say for a big trip or a home project, you can always dip into the principal. But the foundation of your plan doesn't rely on doing that every year. That gives you the flexibility and the peace of mind. Now, how do we build a dividend and interest portfolio? How does it actually work? It's not about chasing the highest yields. That's a recipe for risk. So it's not what you might think. You don't look for the stocks that pay the highest dividends. But we also can't look for the stocks that pay the lowest dividends because they don't really give us a lot. If you look at Apple, for example, they might pay a dividend, but they don't pay a lot. So instead, it's about balancing quality, diversification, and stability. Here's what that could look like. Dividend-paying stocks, established companies with a history of increasing dividends. So think of consumer staples, utilities, healthcare, and dividend exchange traded funds. Typically, we like to look at stocks or companies that are in the S&P 500. For bonds and fixed income, look at high quality corporate bonds, treasuries, municipal bonds, and that provide the steady interest. For preferred stocks and real estate investment trusts, for some clients, these can add yield and diversification, although be careful because they might have some added risk. We typically would look at more publicly traded investments. Then there's cash or CDs to cover the near-term spending volatility. The key is to create an income stream that covers your essential expenses, ideally without having to sell shares at a loss. Now it comes down to tax efficiency. How do we take it out with tax efficiency in mind? Because this is where most of the retirees could lose out. You've worked your life saving and investing, and the last thing you want to do is give more to Uncle Sam than you need to. So here's some strategies that I often recommend. First, let's look at sequence of withdrawals. The order you take money from can count and matter most. A common and efficient sequence looks like this. From taxable accounts first, these have favored capital gains and dividend rates, and you can often harvest gains or losses strategically. Number two, you can look at tax-deferred accounts as the second place to draw from, like traditional IRAs, 401ks. And once you reach that required minimum distribution age, you're forced to take money from there anyway. Lastly is your Roth accounts. Let these assets grow tax-free as long as possible or use them for large expenses later. So you can control your taxable income and manage things like Medicare premiums and Social Security. It's crucial for retirement and to help you lower your taxes. The other thing you can do is Roth conversions. So before you start taking Social Security or during low income years, early in retirement, you can convert your money from traditional IRAs to a Roth IRA. You'll pay on the conversion now, but future withdrawals are tax-free. This can help reduce your future required minimum distributions and help you stay in a lower tax bracket in the future, provide you some tax-free income later in life, and create the flexibility for unexpected expenses or legacy planning. Then we can do some tax loss harvesting and gain harvesting. If you hold taxable investments, you can harvest the losses to offset gains and reduce your tax bill. Or in low income years, you can harvest gains, selling appreciated assets while staying in the 0% capital gains bracket. These moves add up over time. And then we have asset allocation. So thinking of this like putting the right investments in the right buckets for tax purposes. You want to put your tax efficient investments like exchange traded funds and municipal bonds in your taxable accounts. You want to put your tax inefficient investments like bonds or real estate investment trusts in IRAs or 401ks. And you want to keep the growth-oriented assets in Roth accounts where all the future gains are tax-free. By optimizing asset allocation, you can increase your after-tax returns without taking more risk. And then you can also do something called charitable giving strategies. If charitably inclined, qualified charitable distributions from your IRA can be incredibly tax efficient once you're over the age of 70 and a half. Instead of taking your RMD and paying taxes on it, you can send that money directly to a qualified charity. It counts towards your required minimum distribution, but doesn't show up as taxable income. And that's a win-win for you and the cause that you care about. And then we have also the real world balance. Now, I want to be clear, living off dividends and interest doesn't mean you'll never touch principal. There will be times when you need to tap into savings for healthcare, a car, home maintenance, or that dream trip to Italy. The difference is that you're not relying on selling assets every year to survive. You're building your plan around sustainable tax-efficient income and using your principal strategically. Now, there are some common misconceptions when it comes to dividends and interest. So let's tackle a few misconceptions I hear all the time. One is, aren't dividend stocks risky? Well, yeah, stock prices fluctuate, but remember, dividends are far more stable than stock prices, even during downturns. Most established dividend-paying companies continue to pay their dividends and often increase their dividends. If your portfolio is diversified, that income can remain remarkably steady through different market cycles. The other misconception we might hear is interest rates change. What if bonds drop in value? True, but if you're holding bonds for income, you're focused on the coupon payment, not the market value. One key thing here is if you are using bond mutual funds, you are subject to that interest rate risk. You could look at buying those bonds individually, and that way you wouldn't have as much of that interest rate risk. And as bonds mature, you can reinvest at new rates. So over time, your income can actually adjust upwards as rates rise. Now, there's also the worry that companies could cut their dividends, and that can happen. But diversification helps here too. If one company cuts its dividend, others may raise theirs. And with dividend ETFs or mutual funds, that risk is spread across hundreds of companies. If you're buying individual stocks, you just want to make sure you have enough to diversify. And one thing we like to look at is diversify across different sectors. So you're not holding just all technology or all healthcare or all the utilities. You want to make sure you're across different sectors. The key is quality, companies with strong cash flow and long history of rewarding their shareholders. Now we need to integrate this into your retirement plan. Here's what this might look like in practice. Let's say you have $1.2 million in total assets, 500,000 IRAs, 400,000 in taxable investments, and 300,000 in Roth IRAs. You might structure it like this: taxable account, dividend paying stocks, municipal bonds, and ETFs generating tax favored income. In your IRAs, higher yield bonds, preferred stocks, and other income producers. For Roth IRA, growth oriented equities. Your income might come from the dividend and interest in the taxable and IRA accounts, while your Roth continues to grow tax free for later use or inheritance. Add in your Social Security and maybe a small pension, and you've built a retirement paycheck that's stable, tax smart, and flexible. Numbers aside, the biggest benefit of this approach is the emotional part. When you know your investments are generating income, you don't panic when the market dips. You can stay invested, stay disciplined, and focus on enjoying your retirement, not worrying about every headline. That's priceless. So how do you get started with all this? First, get clear on your income needs. Know exactly what it costs to live the lifestyle you want. After Social Security and pensions, figure out what your potential gap is. Number two, look at your current portfolio. What is your current yield that you're getting? How diversified is your income at that point? Number three is look at and identify tax opportunities. Look at Roth conversions, gain harvesting or asset allocation or asset location improvements. Number four is build a written income plan. And this is something we do with every client, mapping out exactly where income will come from, how it will adjust for inflation, and how it will affect your taxes each year. Having a clear written plan is what separates those who hope their money will last from those who know it will. So if we're going to bring it all together, you've got several options when it comes to retirement withdrawals. The 4% rule, simple but rigid. The bucket strategy, protective but requires management. Dynamic withdrawals, which is efficient but could be emotionally tough. Annuities, guaranteed but they're not very flexible. And finally, living off dividends and interest. Steady, tax efficient, and empowering. Each has its place, but for many retirees, focusing on income-producing investments and coordinating withdrawals tax efficiently strikes the best balance of sustainability, peace of mind, and flexibility. So if you take one thing away from this, let it be this: retirement isn't just about how much you've saved, it's about how you take the money out. A thoughtful, tax-efficient withdrawal plan can extend the life of your portfolio by years, even decades. And when you structure your retirement income around dividends, interest, and smart tax strategies, you're not just building a portfolio, you're building a paycheck for life. That's how you retire with confidence. If you're not sure whether your current withdrawal plan is tax efficient or sustainable, I encourage you to get a second opinion. At CFG Retirement, that's exactly what we help clients with, building retirement income plans designed to last through all market cycles with an emphasis on tax efficiency and peace of mind. Because retirement shouldn't be stressful, it should be rewarding. So if you'd like to take us up on looking at your current situation, there will be a link below to set some time up with us. As always, thanks for joining me today. If you found this helpful, make sure you like, share, or subscribe for more retirement planning insights. And as always, live with purpose, plan with confidence, and enjoy retirement you've worked so hard for. I'm Vince Oldry. I'll see you next time.